So today we are discussing the Picant company question. It's a group company. Okay, Picant is a group company, and we will understand about this question. The point here is the point here is on 1st April. Just a second. Okay. Let's move forward. So Picant company on 1st April 2003. So there is a parent here which is Picant. Picant is the parent and Sanders is the subsidiary. You know how the parent and subsidiary relationship is. So this Picant has 75% holding in Sanders. Okay, Picant has 75% holding in Sanders. So Picant definitely is a parent. Let's move forward and read the information. On 1st April, so you should understand when did Picant acquired Sanders. So on 1st April, Picant has acquired 75% stakes in Sanders. And how did they acquire Sanders? There can be many types of considerations. One is directly cash consideration. One can be share exchange. One can be any kind of other like consideration can be paid instead of cash as well. So there can be different scenarios, right? So here, what is the condition given? That is what we have to understand. The condition given for acquiring the subsidiary company by the parent. Let's see. So Picant acquired 75% of Sanders equity shares in share exchange of 3 shares in Picant for every 2 shares in Sander. So Picant has given 3 shares of themselves, okay, to Sanders in exchange of 2 shares of Sanders. That means very simply, Picant has taken 2 shares from Sanders and given 3 shares to Sanders of their company. So 3 shares of Picant has given 3 shares of Picant company. Picant company is giving to Sanders and taking 2 shares of Sanders company. So 3 shares for 2 shares. That is the criteria. Now, the market prices of Picant companies and Sanders company shares are given at the date of acquisition. That is 3.20 is Picant's market price and 4.50 is Sanders market price. Okay. Now, some additional information. So this all information you have to note down. Okay. Market prices of both the stocks. In addition to this, Picant agreed to pay. So it is not only the share exchange which is happening. One more amount, one more different kind of consideration will be paid by the parent to subsidiary. So what is that consideration? Let's see. In addition to this, that means addition to share exchange, Picant agreed to pay a further amount on April 1, 2004, that is at the end of the year. That was contingent upon the post acquisition performance of Sander. That means they will pay to Sander after acquiring Sander on some precondition. Contingent consideration is nothing but if Sanders, the subsidiary, will satisfy some criteria, the Picant parent will also pay some extra amount to subsidiary or Sanders. Okay. And what is that amount they are going to pay? Let's see. So why will Picant pay extra amount to Sanders if Sanders satisfies certain condition? That is called contingent consideration. So whenever contingent consideration case comes, you have to see whether some discount factor is given or not, because the contingent consideration which is going to be paid by parent to subsidiary or Picant to Sanders here is a future amount. So you have to find out the present value as on the date of acquisition. right? For that, you should also know the discount factor. So in certain questions, they'll directly give the amounts. In certain questions, they will give the discounted amount or present value. In certain questions, they'll give the discount factor and the future value, and you have to find out the present value, right? Now, at the date of acquisition, Picant assessed the fair value of this contingent consideration at $4.2 million. That means when the parent is acquiring subsidiary, whatever the contingent consideration parent is going to pay to subsidiary in the future, on the date of acquisition, that amounts fair value. That amounts fair value is nothing but, in the sense, the contingent consideration what they are going to pay to the Sanders or subsidiary, it's amounting to 4.2 million on the date of acquisition. Okay, now just a second, excuse me. Yeah. So I was here, right? So at the date of acquisition, Picant assessed the fair value of this contingent consideration at 4.2 million. Yeah, so they, whatever the amount they are going to pay to the subsidiary of that, whatever contingent consideration the parent is going to make to subsidiary, of that, whatever the amount it is, that amounts fair value as on today. See, at the date of acquisition, Picant assessed the fair value of this contingent as consideration to be 4.2 million, right? So as on today itself, this is the present value what they have calculated. But by 31st March 2004, it was clear that actual amount to be paid would be only 2.7 million. So as on today, the fair value of the contingent consideration is 4.2, but they are going to pay how much? 2.7. That's fixed. That is that. When are they going to pay that? At the end of the year. Picant has recorded the share exchange and provided for initial estimate of 4.2 million for contingent consideration. Initial estimate is on the date of acquisition, right? So all these points are very clear. Let's move forward. So here I will draw a structure after reading this adjustment. On 1st October, see mine date, April 1st, Picant has acquired Sanders. And after that 6 months, after April, October 1st, right? It is 6 months from April 1st, right? They have acquired 40% of the equity shares of Adler. So on October 1st, the Picant has also acquired Adler's 40% stakes, and here 75% stake. So this is parent and this is subsidiary. Sanders is subsidiary, and what is that? Adler is nothing but associate. Correct? Yes or no? Tell me yes or no.
Yes, sir. Yes, sir.
Yes, yes, yes. And Picant acquired Adler's 40% stakes by paying $4 in cash per share, per acquired share, and issuing at par one. See, they are going to acquire the shares of Picant company and going to pay $4 for one share, and also they are going to issue loan notes. And what is the loan note? Issuing at par one loan note of $100 for every 50 shares what they are going to acquire from whom? Adler. So let's see Adler's equity here. Adler's equity is 5,000, right? And each share is of $1. So 5,000 into 1, okay? And they are going to issue like one loan note for every 50 shares. So 5,000 shares divided by 50. How many okay, I will write it here. For 50 shares, one loan note. Is it right? For 50 shares, how many loan notes?
One loan note.
So for 5,000 shares, how many loan notes? Just calculate. We will cross multiply. So 5,000 into 1 by 50. Tell me how many loan notes are required?
100.
100 loan notes, right?
Yes.
So we will take up that one. 100 loan notes, okay? And each loan note is having the value 100 loan notes. Each loan note is having a value of $100, okay? And how much is the parents stake in associate? 40%. So how much is the investment of the not parent? How much is the investment of Picant in Adler, Picant's associate? $4,000. Correct or wrong?
Correct, sir.
Yeah, this is one of the aspects. Other aspect we'll discuss. Don't worry. Now, okay, let's calculate that first investment in associate. We'll do the working notes part simultaneously. So first, let me make the structure here and make you understand the things very clearly. So this is Picant company, okay, and this Picant company has stakes in Sander, that is 75%, and they have 40% stakes in Adler, its affiliate, okay. Now Sanders has been acquired on April 1st, that is April 1st, April 1st, 2003. That is 1 year ago, okay. That means as on 31st March I am saying, and like 1 year ago, that is as per the year end, it is 1 year ago, right? And when I see about Adler, October 1st 2003, that is 6 months ago as per year end. Is it right or wrong? Yes. So these are all
Yes,
the
sir.
conditions given. Yeah. Now we will find out the investment in associate, and we will as usual go for calculation of goodwill. Because whenever the parent is acquiring subsidiary, definitely the first and foremost step you have to find out the goodwill amount, right? And also we will adjust lot of things which is given in the question. So we will go step by step and try to understand how the things go here. So let us find out the investment in associate working notes. Why I am doing this? This is a separate kind of calculation. When I'll be calculating goodwill, I'll be calculating the the subsidiaries value, okay, which the parent has acquired, what they have paid to acquire the subsidiary company, everything I'll be mentioning there. Okay, so now it comes to, when it comes to this, Picant acquired 40% of equity shares of Adler company by paying $4 in cash. So 40% of stakes. So what is the 40% of this? We will write it here. So there are 5,000 shares, right? Here it is very clearly given. You can see here $5,000, $1 each share. So 5,000 shares into $1 makes it $5,000. That means 3 zeros omitted. Let us leave that. So if I see we have how many shares? If I omit 3 zeros, 5,000 shares, right? So investment in associate. So cash consideration paid by the investor in the investee, that is Picant in Adler. There are 5,000 shares into how much is the Picant's stake in Adler? 40%, right? Yes or no? And they are
Yes,
going to
sir.
pay what? What are they going to pay to Adler? They are going to pay $4 in cash. Okay, that is the market value. So it is how much? 40, 20,000, $4, sorry. 2,000 into 4 is $8,000, right? And then 7% loan notes. We have calculated the loan notes amount directly here. What is that loan notes amount we have calculated? $4,000, right? So you remember that. $4,000, and how we calculated I have mentioned here, right? So 100 loan
Yes,
notes,
sir.
one loan note $100, 40%. And it is like, $12,000. Okay, and also this is what the investment what the parent has done in the associate. Okay, that is Adler. And see, this associate company is going to be with the parent, right? Isn't it so? Parent in the sense investor. The associate company is going to be with the Picant company. So now whatever the investments the investor has done, they have to show that in the balance sheet or SOFP, group SOFP, right? So they will be showing the investment, they will be showing the investment value or whatever the investment they have done in associate. They have to add the current year's profit also, right? Which they are supposed to get, isn't it so? Now, so Adler's post acquisition profits. Why I am adding Adler's post acquisition profit? Because this investment has been done 6 months back, and whatever it is in 6 months, Adler has earned certain profits, and those profits belong to whom? Picant, the investor. So those profits have to be added to investment value, and this will be shown in the SOFP, group SOFP. So Adler's post acquisition profits, we have to go to the balance sheet. Yeah, so this is the Adler's post acquisition profit, that is on 31st March 2004, 6,000. So we will take up this one, 6,000 into 6 by 12. Okay, because the acquisition has happened in midway, into 40%. Calculate and tell me the amount, Ketan, fast. Hello.
1,200.
1,200. Okay. So let's add this and then do the totaling. Come on, tell me the total.
$13,200.
So 13,200 is the amount of investment in associate, and this will be shown in the SOFP, group SOFP. Okay. Now, so we have done one of the adjustments. We were here showing the group structure, right? Now we will do the calculation of goodwill. Let's understand how to calculate goodwill. Calculation of goodwill. So for calculation of goodwill, what do you want? Consideration transferred, right?
Yes, sir.
So what is the consideration transferred? There is a share exchange happening here, right? And also a contingent consideration. So we will see what is that. So we will see what is that. So share exchanges for every 3 shares in Picant, they are taking 2 shares of Sander, right? So how many shares are there in Sander? There are 8. So this is the balance sheet. You have to check it here. This is Sander company. Okay. So Sander's shares are given as 8,000. Right now. So consideration transferred, share exchange. So for that, what will take? For every 3 shares, they are for every 2 shares of Sanders, Picant is giving 3 shares, right? So 2 shares of Sanders, Picant is giving 3 shares. For 8,000 shares, how many shares will Picant give? We'll calculate. Come on, tell me. See, every 2 shares of Sanders, Picant is taking and giving them 3 shares, right? So 8,000 shares are there in
12,000.
Sanders. Yeah. So Picant will give them how much? 12,000
12,000.
shares. So this is, so 12,000 shares, and in that also the parent is taking how much? 75% into what is the market value of each share, because they are giving 12,000 shares. Who is giving 12,000 shares? Picant. And Picant, each share is trading at what price?
3.2.
3.20. 3.20. Can you tell me the amount here? So Picant is giving their shares, so their share value or their share is trading at 3.20. So we'll take up that value. Come on, tell me.
28,800.
28,800. One part of the thing is done. Okay. Second is, this is one part of the consideration. Second, they have also gone for contingent consideration, and the value of that contingent consideration as on today is how much? 4.2 million. Is it right?
Yes, sir.
Yeah. So we will consider, see, on April 1st, 2004, okay, this is done. At the date of acquisition, Picant assess the fair value of this contingent consideration is 4.2 million. But they paid this much. That's a secondary matter. But we will take only the pre-acquisition ones, right? Now, or on the date of acquisition. Goodwill is calculated on the date of acquisition. So, contingent consideration. Contingent consideration happens to be, so 3 zeros are omitted, you should be knowing, right? 4,200. Now what is the total? Please tell. It's 33,000. Okay. Now see, we are doing the calculation of goodwill. So we also know that since Picant has acquired 75% stakes in Sander, 25% is 25% stakes of Sander belongs to non-controlling interest, right? And now we have to look for the information regarding non-controlling interest, and also we have to see how they are maintaining the non-controlling interest. They are maintaining the non-controlling interest at fair value or not. If it is so, then we have to show it at the fair value. So let us see that. So We'll go ahead. Yeah. Picant's policy is to value the NCI at fair value at the date of acquisition. So they will value the non-controlling interest at fair value. So now see, this NCI are the investors in Sanders, right? And Sanders, each share is trading at what price, boss? It is trading at 4.50. Yes or no?
Yes, sir. Yes, sir.
So now we will calculate the NCI value. So calculation of NCI value. So NCI value at acquisition. So we know how many shares the Sanders have. They have 8,000 shares. Each share value is how much? Face value, I'm saying. Face value happens to be $1 itself, I think. Yeah, $1 for both. For all, it is $1, right? Now, so 8,000 into, so $8,000 into 25%. 8,000 shares actually. 8,000 shares into 25%. Why I'm not taking $8,000? Because I have to show it at market value or fair market value. Each share is trading at 4.50 Sanders share, in which NCI is an investor. So can you tell me the amount here?
9,000.
So this happens to be 42,000. Now, do you think it is the end? So for goodwill, what we need? We have just calculated the consideration transferred and NCI value less net
Net
assets
assets.
acquired represented by equity. Okay. So fair value of net assets, fair value of net assets acquired represented by equity. So now we have to find out all that, and then we have to put the amount here for goodwill calculation and check whether there is any impairment in goodwill or not. If there is an impairment, we will adjust the impairment also. Whenever you calculate goodwill, you have to check for the impairment as well immediately. Mark my words, during the examination you have to see for that as well. Now, so we will take up all these things and find out the net asset value. Okay, so we will go for the calculation of net asset value. Give me a second, Ketan. Okay, calculation of net asset value. So you know net assets acquired are represented by equity, right? So for us, what matters is like on the date of acquisition. So we will do the calculation here and see the movements also, and also check the values of those things on reporting date, right? Now, so what comes under equity? We will take up the share capital and Sanders company we are acquiring. So Sanders company's net assets we have to take, which is represented by equity. So 8,000, 16,500. Okay. And this is at the year end, but we want only on the date of acquisition. So this doesn't matter for us. Retained earnings on date of acquisition is given to us. Okay. Pre-acquisition retained earnings are given. Post-acquisition retained earnings are given. Pre-acquisition matters to us. Now, so first we will take share capital. And we will make 3 columns here on the date of acquisition, on the reporting date, and also post acquisition. What is the value of all these things? Okay. In the exam, you can make a schedule of this kind to calculate. So share capital happens to be how much? 8,000. Let's take that. On date of acquisition, the dates are given, right? 8,000 and 16,500. 8,000. Retained earnings 16,500. Okay. And then what is that? We will check out. So this is the case, and some adjustment related to them we have to check. Okay. What we have to see here. So share capital and retained earnings. So share capital 8,000, and on reporting date also it will be 8,000. Reports we will be preparing at the end of the year, right? So what is that given here? 3.8 March 24. What is that given? We will see some details here. What is given regarding certain things. So retained earnings we need to calculate. We will calculate that part, and we will see like how to like, or what value we shall be putting. Okay. So as of now, the retained earnings of Picant on reporting date. Details given regarding this. Retained earnings. Sanders retained earnings. This is on 31st March 2004, at the end of the year. They have mentioned, okay, this is the balance sheet given, the group balance sheet given. Okay, there are certain things we need to understand. See here very clearly, the summarized statements of financial position of all 3 entities at 31st March 2004 are this. So this is the equity at the beginning and also equity at the end, because this is the equity at the end, right? Yes. Hello.
Yes, sir.
Yeah, so they did not mention any dates how much was the shares at the beginning. They are showing that these many shares are there at the end of the year, and I don't see any kind of extra capital has been raised in this year. So we will put this as usual. So this is the on date of acquisition and also on reporting date, and there is no change. No additional capital has been raised post acquisition. But when it comes to retained earnings, they are very clear. They clearly say retained earnings on date of acquisition is 16,500, right? So we have written on date of acquisition. Then what about the post acquisition retained earnings? We have to check. We have to check. See, listen. See, I am telling you some point here. Please understand. See, retained earnings on the date of acquisition is how much? Ketan?
16,500.
And what is the year-end profit of subsidiary?
1,000.
So what is the post-acquisition retained earnings?
15,500.
How 15,000? 17,500, right?
And we have to add
Yeah, we have to add.
Okay, okay,
This is the profit at the year end.
okay.
See, opening balance is 16,500 and at the year
Yes,
end the retained earnings is 1,000. So it is 17,500, right?
yes, sir.
So on reporting date, it is 17,500 and 1,000 is the post acquisition retained earnings. Is it right? Till here everything is clear.
Yes, sir.
Now some information we need to search here if it is given. Okay, they have given some information here, so we need to check. At the date of acquisition, fair values of Sanders property, plant and equipment was equal to its carrying amount. That means fair value is equal to carrying amount. Whatever was shown in the balance sheet, that amount and the fair value, that is the price of those assets which should be in the market are one and the same. That means what they are showing in the books is equal to what it should be in the market. But only one thing, one particular asset was having an exception in this case, with the exception of Sanders factory, which had a fair value of 2 million above its carrying amount. That is what. Okay. So on this is something which is happening on the date of acquisition. On date of acquisition, all the assets of Sanders, okay, all the assets of Sanders in the books or carrying amount of the assets was equal to the market value of the assets, except one asset, that is factory, Sanders factory, which was $2 million above the carrying amount, right? So we have to adjust this also on date of acquisition. Factory on reporting date also it is 2000, right? And post acquisition, this is on the date of acquisition only. Did they tell you anything about this? What they're saying, Sanders has not adjusted the carrying amount of the factory as a result of fair value exercise. This requires additional depreciation of $100,000 in the consolidated financial statements in the post acquisition period. So you have to depreciate this asset, right? In the statements, and that too on the reporting date, correct? Or post acquisition period, correct or wrong? So we will adjust
Correct.
that. So we will adjust the depreciation here. Sorry, we will adjust the depreciation, fair value depreciation. So whatever we will do that post acquisition, that is after acquiring the company. So here we will adjust 100 on the reporting date and also post acquisition 100, right? Now all these adjustments are clear. One more adjustment we need to discuss, and this is a very important adjustment. I will explain you this with the help of some example. You should be understanding, and such adjustments they may give you to test in the examination. Also, at the date of acquisition, Sander had an intangible asset of $500,000 for software in its statement of financial position. So they had some intangible asset, that is a software, okay, in the SOFP. And Picant's directors believed the software to have no recoverable value. That means it is not going to give anything to them. And At the date of acquisition, and Sanders wrote it off shortly after its acquisition. That means they are showing that as a loss. This $500,000 intangible asset is of no use for them. It is worthless, and they want to show this as complete loss. That means they are writing off it. They are writing it off from the books. And when they are writing it off, they are writing it off on date of acquisition or after acquisition.
After acquisition.
So the point here is this particular adjustment we have to do. See, this intangible asset belongs to Sander company, right? And it is with the Sander company before the acquisition has happened, right? And like this, they have discovered that this is a worthless asset for them, right? At the date of acquisition, Sander had an intangible asset of this much for software in its statement of financial position. Already they are having this software with them. They are showing in the books in the balance sheet, but they thought that this is this will have no recoverable value in the future. So since it will have no recoverable value in the future, they have to, write off this. Fine. And what they are doing is they are writing it off in the next year, which is not something, this kind of things have to be adjusted on the reporting period. Am I right or wrong?
Yes, sir. Right.
Events after reporting period. See, this is something which is adjustable event, right? Yes. See, in this question, they are saying uh, like pre-acquisition, they had an asset and they are saying that they have expensed it in the next period after post-acquisition. So now, whatever the written off, whatever they have written off is the total amount. That is a loss. They should be doing that. Okay, they should be doing that in the previous year, which they are doing in the next year. So we will remove this from the previous year, that is on acquisition date, and we will add back this value on the post acquisition. Why? Because this does not belongs to post acquisition period. This belongs to acquisition. This belongs to pre acquisition period, or on the date of acquisition they should be doing this adjustment, right? Hello.
Yes.
Because
Yes, sir.
see what happens, some expenditure which belongs to previous year has to be adjusted in the previous year. They cannot adjust that in the next year. If they do that, next year's profit are understated and previous year profit are overstated. Am I right?
Yes, sir.
So they need to do this. They did this after the acquisition period, which they shouldn't be doing. When they discovered or believed that this is worthless, they should be adjusting it in the previous year itself, and they should not be showing the previous year's expenditure which belonged to previous year in the next year. That is a wrong treatment. So if they have shown that in the post acquisition period, they should add back, and they should be what they have already shown as a what they have shown as a loss in the post acquisition period, they should reverse that, and what they have not shown in the pre acquisition period, they should show that. Am I right?
Yes, sir.
See, they have shown the losses in the post acquisition period, so they have to reverse this, and they have to show this loss in the pre acquisition period.
Yes, sir.
So they should show this loss here. Okay. So what they will do, they will show a loss here, and whatever they have shown as a loss here, they will remove it, or they will add back that amount, so that here's so that what will happen, it will nullify the effect. Understood? Now, so I will do that treatment here. What we will do here, so if I tell you a small example downside, let's say I give you an example. Let's say you have pre-acquisition some amount of 84,000, right? Hello. So hello, Ketan, are you active?
Yes, sir.
So I told you, you have to do certain adjustments. You have to reduce pre-acquisition amounts, and you have to increase post-acquisition amounts. Okay. So I'm giving you a situation. Like the situation will help you to understand this in a better way. Okay. So if the situation is like this, we have been given some situation, okay, the pre-acquisition situation, and we have been told that something should be expensed in the pre-acquisition period. So we have been given a pre-acquisition amount 84,000. Okay. And we are told that 3,000 should be written off in the post acquisition period. Okay, we have been given certain asset or something, some amount here, and we have been asked that you have to write off 3,000 from this value in the post acquisition period, right? which in turn should have been adjusted in the pre-acquisition period. So something which you would have done in the pre-acquisition period, you are doing in the post-acquisition period, right? So what we need to do, what we have done in the post-acquisition period, we have to increase the post-acquisition because we showed the expense in post-acquisition period, right? So we will increase this so that that will nullify this expense and we will reduce the pre-acquisition amount. Okay, can we do that?
Yes. Yes.
Yeah, so I will show that with the help of an example. 84,000, 3,000 is given here, and post-acquisition, the amount is 95,000. The total is 1,79,000. Okay, so what we will do, so reduce 3,000, bringing this 84,000 down. This is post-acquisition. Sorry, this is the pre-acquisition, right? So whatever expenditure we have shown in the post-acquisition, what we need to do? We need to add. Correct?
Yes, sir. Add.
And we need to make this 98,000.
98.
And whatever we have, reduce the like whatever we have, whatever the expenditure we have shown in the post acquisition period, because of which the post acquisition amount has got reduced. Actually, the post acquisition amount should be how much? 98,000, but it has become 95,000. Why? Because we reduced the post acquisition amount by 3,000. Isn't it so? We reduced 98,000 by 3,000, so it became 95,000. We shouldn't be doing that. So we need to correct ourselves. So we add in the post acquisition and we subtract this amount in the pre acquisition and make it 81,000.
81,000.
So 81,000 plus 98,000 is still how much? 1,79,000, right?
Yes, sir.
That's what. So amount is still that, but the treatment has been incorrect. So incorrect treatments can lead to some kind of ambiguity.
Yes.
Errors or ambiguity or confusion. Errors. Yeah, so now we will adjust all this software written off. So we will what we have done in case of software write off, we will deduct the pre-acquisition and we will add the amount in the post-acquisition period, right? We did that. Pre-acquisition or on date of acquisition, we will subtract because the expenditure belong to that date and we will add it in the post acquisition period. Now let's do the total and find out the net asset value. Come on, tell me, Ketan, fast. 8,000 plus 16,500 plus 2,000, 10,000, 10,000 plus 16,500 is 26,500. 26,500 minus 5 is 26,000, right?
Sir, 26.
And do this one, 10,000, 27,500, 27,500 minus 100. 27,400 and here it is 1,400. Correct? Yeah. So this is the post acquisition amount. Now we will take up this in the goodwill calculation part and add it there. Fair value of net assets acquired represented by equity. So what is our value? We got 26,000 on date of acquisition, right? See, 26,000 on acquisition date. Now we will subtract this and we will get the goodwill value. But do you think this is the goodwill value? There is some kind of treatment goodwill also have. So we will find out that also. But let us put this here. The goodwill is, how much is the value? 16,000, right?
Yes, sir.
Hello? Yeah, but this is not the final value because there is an impairment loss in case of goodwill that we have to adjust. Impairment tests were carried out on 31st March 2004, which conducted that the value of investment in Adler was not impaired. So Adler's investment, what we have done is not impaired, but due to poor trading performance, consolidated goodwill was impaired by 3.8 million. We'll adjust that here. Tell me the final value of goodwill, the intangible assets.
12,200.
This is the goodwill value. Okay. So let us now move forward. We have done the goodwill calculation. We have done the investment in associate. calculation. We have done the net assets value calculation. Now let's move to the next part, NCI calculation, right? And also group retained earnings. See, whenever you do a consolidation question, these are certain adjustments. These are certain calculations you have to do. Goodwill calculation, then you have NCI value, then you have group
Retained
retained
earnings.
earnings. Yeah, group retained earnings. And these are the actual ones. And then in between certain adjustments would be there, right? So those kind
Yes,
of,
net assets.
yeah, net assets is what sometimes directly you can do. Sometimes you have to make you have to make all this schedule and you have to find out, right?
Yes, sir.
Then if it is associate, investment in associate also you have to
Investment in.
find out. Okay, let's go ahead now. This is done. This is done. Okay. Now this is a very, very tough adjustment. We will be going for that also, not a matter of concern. Now let's start simultaneously doing the balance sheet. Okay. And then in between we will put the values and we will do the calculation also side by side. Shall we go ahead?
Yes, sir.
Yes. Yeah. Yeah. Okay, I'll open a fresh page. So we are making the consolidated statement of financial position of Picant. Why I am going for the consolidated statement is I don't see any other adjustment to be done in the asset side. I know group retained earnings I have to calculate. I will calculate within a while. And some adjustment is going to come in asset side. That is goods in transit. I will explain that while doing the question. Okay. As
Yes, sir.
on 31st March. Yeah. So that will be, the conclusion part of this question. So now we have the non-current assets. What are the non-current assets you have? Let's go into the balance sheet. You have the property, plant and equipment. You will be taking the Picant's value. You will be taking the Sanders value. And you will be we have calculated the fair value of the assets. Okay. We want the book values, right? So there was so whatever the schedule we have put and did the calculation was about the fair value. You understood, right?
Yes, sir.
Hello. Yeah, we want just a second. Yeah, so we want the book values of the assets. So we are taking up the book values and there is no other adjustment for property, plant and equipment, no depreciation kind of, because we are doing consolidation questions. But one thing you need to consider. What is that? See, in the first adjustment, they have given something, right? What they have given? At the date of acquisition, the fair values of Sanders property, plant and equipment was equal to their carrying amount. On the date of acquisition, we are making the statements at the end of the year. Only one exception was there. Sanders factory, which had a fair value of 2 million above its carrying amount. Okay. Sander has not adjusted the carrying amount of the factory as a result of fair value exercise. So now we need to adjust or not?
Yes, sir. Adjust.
Yeah, and that needs a depreciation also, right? Of this much. So we will adjust. So they did not adjust it. Now we have to adjust it and show. So non-current asset, what is there? So we will take 2 million of factory and also we will do the adjustment part, right? That is the fair value. That is a depreciation. So 37,500 PPE plus 24,500. This is given at the end of the year. See, the summarized statements of financial position of three entities as on 31st March 2004 are. Can I say this is the book value at the end of the year? Can I say this is the book value at the end of the year? Only what is not adjusted to this? $2 million plant, right?
Yes, sir.
Yes. Yeah, so we will take that $2 million plant here. They have clearly said at the date of acquisition, all these things are given. Sanders has not adjusted the carrying amount of factory as a result of fair value exercise, and this requires additional depreciation in the consolidated financial statements in the post acquisition period. So since that is clearly given, they did not adjust it, and depreciation will be in the post acquisition period, and the adjustment should also be done in the post acquisition period, right? They did not do it. That was their mistake. So we will add 2000 and we will take out that 1000 fair value adjustment, depreciation, 3 zeros omitted, right? So we will take 200 here. So tell me the value here. What is the value you're getting?
63,900.
This is done. Goodwill. Goodwill is an intangible asset we have already calculated, right? What is the goodwill amount we got? Goodwill, where did the calculation? We did it here, right? Okay, 12,200.
12,200.
Done. This is also done. And investment in associate, since Adler company is also there, so investment in associate is also calculated by us. How much was the amount of investment in associate? Investment in associate is that we have calculated, right? Yeah, it was like 13,200, right? We have calculated. This is done, Ketan. Next. Hello.
Current assets.
Yeah, we got the non-current assets. Just add this value and we'll go for the current assets. And there is an adjustment here. We will adjust. Tell me the value.
89,300.
A very crucial adjustment is going to come. The adjustment is here regarding the current assets. See, on 31st March, Picant's current account with Sander was 3.4 million debit. That means Picant is supposed to receive this much from Sander. Okay. This did not agree with the equivalent balance in Sander's books due to some goods in transit invoiced at 1.8 million. That means 3.4 million debit balance is shown, but 1.8 million is still to be received from Sanders. Because some goods are in transit, right? So the goods haven't reached, or see, when goods are in transit, that means the goods haven't been received. Okay. And that shows that there can be some differences between the balance in the parent's account. Okay. And since Sanders haven't received the goods, it's in transit still. The invoice has been sent. Okay. But the goods are in transit. We need to adjust that, right? So what they're saying, on 31st March, Picant's current account with Sander is this much. Sander has to pay this much to Picant. Receivables, these are what actually? Hello? These are what? Receivables, yeah. Picant's receivables from Sanders. This did not agree with equivalent balance in Sanders' books due to some goods in transit invoice. So if parent is showing that they have to receive this much from the subsidiary, subsidiary's book should also show this much amount, right? But the balances are not matching. They are that is not matching because of certain goods which are in transit right now. Yes or no?
Yes, sir.
See, I am showing $3.4 million I'm supposed to receive from you. But you are not showing that 3.5 $3.4 million in your payables. See, this is my receivables I am supposed to receive, but you are also supposed to pay me this much. It is payables for you, right? This is intra-group transaction which should be cancelled out, but you are not showing 3.4 millions. You are, because of this 1.8 million goods which are still in transit, you did not receive, or you did not receive the bill for this. Is it right?
Yes, sir.
And that too, parent has sent that, but had not been received by sender until after the year end.
Yeah, okay.
Picant sold all these goods at cost plus 50%. Now we have to do the provision for unrealized profits, and we have to like do the adjustment for all this. So my adjustment for all this is very simple. Such kind of if you get such kind of scenarios, what you need to do? First, you have to deal with goods in transit. Okay. So what is the journal entry for that? I'll write it here. This was the balance sheet we were making. So goods in transit is inventory account debit to payables. Is it right or wrong?
Right, sir.
What is happening in case of goods in transit? Your inventory will increase and your liability will also increase, right? That will be $1.8 million and $1.8 million. Correct or wrong?
Correct, sir.
Then there is an intra-company receivable and payable of $3.4 million, right? So we have to eliminate. Eliminate the intra-company transaction. Intercompany, sorry. So how will you eliminate? The elimination will be like, from payables you will remove and from receivables also you'll remove, right? So payables account debit to receivables account. Okay, that is 3.4 million and 3.4 million. Intercompany transactions have to be cancelled out, and goods in transit I have shown the entry because it is going to increase my inventory and increase my payables. Sorry. See, at the end, what is happening? Your payables are going to get adjusted, right? 3.4 million and 1.8 million. What is the difference going to be? Hello.
1.6.
1.6 million, because it is in credit, it is in debit. They will cancel out, right? They will cancel out and the net amount will be this. Okay. So that is what just I'm explaining you, right? These are the entries I have made. Simply understood? Clearly understood?
Yes, sir. Yes, sir.
And then one more thing is happening. We have to also remove the provision for unrealized profit. We have to remove this also, because the goods have been sold at profit by the parent to subsidiary, right?
Subsidiary.
So this we will be doing while we will be making the group account. Now shall we move forward?
Yes, sir.
Yeah. So coming to this inventory, we will write. So inventory is how much, boss? Inventory is 10,000 and 9,000. Let us take that. And what is the journal entry I have put? You have to increase your inventory by how much?
1,800.
Yeah, this
1.8.
is because it is like, goods in transit, right? So we are making group accounts. So it is increasing the inventory for one party and increasing the payables for one party. We will first deal with this and then we will eliminate the intercompany transactions.
Yes, sir.
So we will add 1,800 goods in transit. Okay. And then we will remove, I have already explained you one more thing. We have to remove the provision for unrealized profit. So we will, yeah, we will see what is the unrealized profit part here. We have to calculate. For that, we have to go into the adjustments again. So it is at 50%, cost plus 50%, right? So
Yes.
let's do the calculation. It is like we will make the equation 100 plus 50 happens to be 150. The goods invoiced are 1.8 million. So that represents the selling price. Can you tell me what's the cost price, Ketan?
$1,200.
Yeah, so 1200 goods, $1,200 costing goods are sold at 1800 and the unrealized profit would be 600. Why? Because this has not been sold to any outsider, right? It's an intergroup transaction, intercompany transaction. We will adjust that unrealized profit here from the goods in transit. That is the inventory which has been sold at profit, right? So tell me the value.
Yes, sir. 20,200.
20,200. Okay, now let's go for the trade receivables because that's the leftover one. 6,500 and 1,500. What did I write about this? Eliminate the intra-group, intercompany transaction. That is, I have credited the receivables. So I'll remove this from the receivables, right?
Yes, sir. 3,400.
That is intra-group transaction. Come on, tell me. Intercompany intragroup,
4,000.
or intercompany. How
Yes,
much?
sir. 4,600.
Can you tell me the assets total now?
Hmm. 24,800. 24,000.
Yeah, total amount, total of assets.
Total. Okay. Huh. 1,14,100.
Yes. So one part of the question is done. We are going to the balance sheet now. Shall we do that?
Yes, sir.
One part of
Equity and
we are going to the liability section now, equity and liability section. Okay. So equity and liabilities. So what is the equity attributable to owners of the parent? We will take the parent's capital. You already know that, right?
Yes, sir.
We will take the owner's capital only. 25,000. And then we will take up the next, anything is given. Share premium also we will be taking of the parent, and retained earnings will be doing the calculation because certain profits and everything have to be added up. Share premium. What is the amount of share premium? 20. What is that? 19,800, right?
Yes, sir.
Yeah, so we will put that here. So this is the amount of share premium. Then comes the retained earnings. So we will see the retained earnings here, the group retained earnings. So what we will be doing under group retained earnings is we'll be taking the parents retained earnings first. Okay, what is given here? We'll be taking up the Picant's retained earnings. That is 16,200 and 11,000. Just add and tell me how much is this pre and post, the total retained earnings. Just a second. Calculation of group retained earnings. Yeah. Now, so Picant's retained earnings. What is the Picant's retained earnings? 16,207, 27,200, right?
Yes, sir.
That is 16,200 plus 11,000 pre and post. This is the parents one. But whatever the post acquisition retained earnings of the subsidiary, that will be taken by the parent, right? And shared with the NCI as well. Now, Sanders post acquisition retained earnings. We calculated that, right? That was how much? 14,000 somewhere around 1400 something. Is that? Did the calculation? It was very clear. See, post acquisition. What was the like total amount here? Retained earnings amount, equity amount
1400.
1400, right? Because equity in the sense capital was not there, only retained earnings and certain adjustments were done to retained earnings. So 1400. So we will take up that 1400 and only 75% would go to parent. Can you tell me the amount? Hello.
The 1050. 1050.
See, impairment loss has been removed from the goodwill, right? But this impairment loss also is a loss, has to be adjusted in the statement of profit or loss or retained earnings. So we will do that. See, two adjustments will happen. One adjustment we have done, one adjustment we are doing right now. But we'll take only the group share of impairment loss, right? See, you have removed from goodwill, right? That has been done and the amount has been shown
Yes,
in the
sir.
balance sheet. But here also we have to show the another treatment. Group share of retained earnings. So 3,800 was there. Of that 75% we will take. What is the amount?
2850.
Now next. Adlers, the investees post acquisition profits. So they have to, that has to be like taken, that has to be taken by the investor, that is the group, Picant Sanders group. And one treatment we have done already, we have added that to the investment value and shown in the balance sheet asset side. And here also we need to account, right? It's a investment income from investments. So I think how much is the profit? Post acquisition 6,000.
6,000.
Into it has been acquired 6 months after they acquired Sanders, and then 40% is what they should get. How much?
1200.
1200. Okay. And then you already know that some inventory loss also we have seen, goods in transit. So provision for unrealized profit in inventory. That was 600, right? That we have already calculated, because 1200 worth goods were sold for 1800. There was an unrealized profit of 600, which we have taken. Now, yeah, next. Next, one more adjustment is there. See, you remember that they have like on the date of acquisition, how much they wanted to pay 4.2 million, but they paid only how much? 2.7 million at the end. So they have got some kind of gain in this part, right? Just a second, kid.
Yes, sir.
Just a second. Ketan, एक second. Just give me a second. Okay, Ketan. Let's follow. Hello.
Yes, sir.
Ketan. Yeah, Ketan. Now. So now we have done that unrealized profit adjustment as well. Yeah, we were also looking into this, right? That there is some gain in this. What is the gain? See, they were supposed to pay 4.2 million, but they paid only this much. So they saved a certain amount, right? It's a gain. It is gain from reduction in contingent consideration.
Yes, sir. 1,500.
Yeah. And that is six. How much? 1,500, right? Now can you calculate and tell me the amount? 27,200 plus 1,050, and this is the group share of retained earnings has to be removed.
$33,200.
What did you do for group share of retained earnings?
Wait a minute, sir. I'll check. Yes, sir. Minus we have to do.
Yeah.
Sorry. 27,500.
Why are you subtracting here group share of retained earnings?
Because we are giving a
It's not retained
70. We
earnings.
are acquiring.
It's
We are
in
acquiring. No, sir. Not retained earnings.
impairment.
Impairment. Yes. Impairment. Sorry.
You have to remove
Yes,
the loss.
impairment.
Next. That's what I was saying. This is Adler's profit have to be added, unrealized profit have to be removed and added. Okay, what's the amount?
27,500.
Okay. So 27,500. We have done the adjustment and we have calculated everything. Next, what we need to do? Next in the statement, just a second. Retained earnings is done, right? Can we take, we have to take up the NCI value. Did we calculate NCI value till now?
Not yet, sir, I think. Not
Yeah,
yet.
so we need to calculate the NCI value also. Let's calculate that. NCI. So what is that you have to do in NCI calculation?
That amount of NCI 9,000,
Yeah, you like whatever the amount.
25% share.
Yeah, we will take up that. So NCI at acquisition. So how did we calculate NCI at acquisition? Did we do the calculation of NCI at calculation?
Yes, sir.
What was the amount of that?
9,000.
9,000, right? We did that when we were calculating. So we took 8,000
8,000.
of this and 25% and 4.50, right?
0.5. Yes.
So we will write 9,000 here. And NCI is also going to get the post acquisition share of post acquisition reserves. That is 1,400 into 25%, right?
Yes, sir.
Tell me what's the amount? 20%.
9,350.
Yeah,
350.
350, yeah,
350.
350. And
Total
see,
is 9,000.
yeah, see, impairment loss also. It's not only the group is going to bear. If the NCI, if group is taking the profit and NCI is taking the profit, then losses are borne by the group and losses are to be borne by the NCI. So
NCI too, sir.
impairment loss. Okay. NCI share of impairment loss.
8,000.
Because this was on the date of acquisition only, right?
Yes, sir.
Into 25%. Tell me.
9,500.
1,500, 950. Yeah. Tell me now. Tell me the amounts.
950. 8,400.
Okay, 8,400. So we will take the NCI value in the balance sheet. Non-controlling interest 8,400. Right.
Yes, sir.
Next comes what? We will take up
Non-current
non-current liabilities. Yeah,
liabilities.
non-current liabilities. How much? 14,500 as well as 2,000, 16,500. Non-current liabilities 16,500. Current liabilities. What are the current liabilities?
4,200.
That is contingent
20.
consideration, but we will take only 2,700, right? It has been
Yes.
agreed. What is that? Huh. Okay.
Yes, sir.
And we will be adjusting the payables. Other current liabilities are given as 8,300 and 7,500, and from that we need to remove that intra-company transaction, right?
Yes, sir.
How much we will remove there? We discussed where was the entry of that?
Goods in transit.
Yeah.
Okay.
See, in payables, we have to do two treatments. One is we have to add 1800 and we have to subtract. Sorry. Yeah, we have to subtract 3400, right?
3400. Yes, sir.
Just a second. Right? It's add or less? It's yeah, add and less. Add 1800 and subtract. How much is 3400? Tell me what's the amount here. Okay, okay, sorry, we have to put it here, right? Other current liabilities. 8,300, 7,500. Add 1800, subtract 3400. Tell me the amount, please, fast.
14,200.
Okay. So now, can we do the final calculation of this?
Yes, sir.
And tell me the liabilities, total liabilities and equity. Just do the totaling.
One lakh 41,000. 1,14,100. Yes.
Okay, 1,14,100.
Yes, sir. It's tallying.
Tallying. Okay. So this question is done. Now I want you to go through this completely and then we will take up one more question. Okay.
Yes, sir.
Okay, Ketan. Thank you. I'll inform the time. Thank you.
Yes, sir.
Yeah. Yeah.